Welcome to the Pro Ticker Deep Dive.
And today we have just a tremendous amount to unpack.
Yeah, that feels like the understatement of the century, honestly,
Right.
because looking at everything happening this morning, I feel a little bit like I'm standing in the middle of a four-way intersection.
With semi-trucks
Mhm.
speeding from every direction. Right?
Exactly. Just total chaos.
It definitely feels that way. I mean, if you look at the calendar, it is Tuesday, February 24, 2026. And I think it's fair to say that today might go down as one of the most confusing, high-tension days in modern economic history.
It's the whiplash, right?
Mm.
That's really the only word for it. Because you have this massive national celebration ramping up, America's 250th birthday.
Freedom 250.
Right, the Freedom 250. And there are Department of Commerce, fish fries, and grand galas being planned everywhere.
A very festive vibe.
But then if you look at the actual economic news feed, it looks like the opening scenes of a disaster movie.
It is a study in complete contradictions.
Wow.
On one hand, you have the administration preparing for the State of the Union tonight, promising a golden age and celebrating the semi-quincentennial.
Right.
But on the other hand, you have a panic ripping through the tech sector that is, frankly, unlike anything we've seen since the dot-com bubble burst.
And that's before we even get to the constitutional crisis over trade that just happened over the weekend.
Exactly. So it's this convergence of three massive storylines hitting us all at once.
Just a perfect story.
A perfect storm. You have the AI scare, which is this new theory that artificial intelligence is about to dissolve the entire software industry.
Which is terrifying.
Yes. Then you have a Supreme Court ruling that just threw U.S. trade policy into a total blender.
Yeah.
And then you have the State of the Union tonight and NVIDIA's earnings tomorrow, which together basically feel like a binary switch for the future of the global economy.
So for you listening right now, the question we're trying to answer today is pretty simple, even if the answer really isn't.
Right.
Are we actually looking at a golden age, or are we staring down the barrel of a self-reinforcing cycle of decline?
That is the essential tension here. Are we growing, or are we just automating ourselves out of existence?
Let's start with the thing that is totally freaking everyone out on Wall Street right now.
Yeah.
The AI scare.
The suspocalypse, as they're calling it.
Right, because up until, I don't know, yesterday, the narrative was that AI is a tool. It helps us work faster. It's a co-pilot.
Exactly. The human plus AI equals superworker. That was the optimistic view we've held for the last few years.
Yeah.
The idea was that AI makes you 10% more efficient, so you do 10% more work, and the company makes more money. Everyone wins.
But now there's this new bearish scenario that just dropped, and it's turning everything upside down. What exactly is the argument here? Because it sounds like they're saying the co-pilot is actually a hijacker.
It's a fascinating, if terrifying, piece of analysis. It essentially argues that AI agents could destroy the economy.
Destroy it. Not disrupt, but destroy.
Right, not exactly subtle. But the argument inside is very nuanced. It challenges the whole idea that AI is just a productivity booster. Instead, it posits that AI acts as an economic solvent.
A solvent, like acid.
In a business sense, yes. Think about how the modern economy is structured. It's a daisy chain of transactions.
Okay.
Company A hires Company B to do their marketing.
Okay.
Company B pays Company C for their project management software. Company C pays a law firm to handle their contracts.
Right. It's services all the way down. I pay you, you pay him, he pays her.
Exactly. And that flow of money between companies is what supports millions of white-collar jobs. What this new scenario asks is, what happens when agentic AI steps in? And we should probably define that, by the way.
Please do, because everyone throws around agents versus LLMs right now. What's the practical difference for someone who isn't a coder?
Sure. So an LLM, like the early versions of ChatGPT, is basically a chatbot. You ask a question, it gives an answer.
It's reactive.
Exactly. But an agent is software that can plan, perceive, and execute. You give it a goal, like plan a marketing campaign, buy the ads, and optimize the spend, and it goes off and does the whole thing without you holding its hand.
So it's the difference between having a really smart dictionary and having an actual employee.
That's a great way to put it. So if agentic AI can do those complex white-collar tasks internally for pennies, the entire daisy chain breaks.
Because instead of hiring the marketing agency, I just tell my internal AI agent to run a campaign.
Precisely. And instead of paying Salesforce or some other SaaS vendor $50 a seat per month for software, your AI just builds a bespoke CRM for you on the fly.
Wow. Okay, so that severs those transactional links completely.
It does. And here is the negative feedback loop that Wall Street is suddenly terrified of. It's a four-step cycle of destruction.
Let's walk through those steps. Step one.
Step one is exactly what we just described.
Yeah.
Companies replace outsourced services with internal AI agents to cut costs.
Okay, makes sense from a margin perspective. What's step two?
Step two is the fallout. Those service companies, the marketing agencies, the legal firms, the software vendors, they lose massive amounts of revenue. Their customer churn spikes.
So they have to cut costs, too.
Right. So what do? They lay off their human workers. Millions of displaced white-collar workers.
Which brings us to step three, I imagine.
Step three. Those displaced white-collar workers lose their income, so they stop spending money.
Right.
They cancel subscriptions, they stop eating out, they delay buying cars or houses. The consumer base shrinks.
And then step four is the doom loop.
Exactly. Step four is that revenue drops for everyone. Retailers, car manufacturers, grocery stores. And seeing their revenue drop, those businesses are forced to automate even more to preserve their own margins.
It's a complete race to the bottom.
It is a deflationary spiral driven entirely by efficiency. Market analysts are calling it a negative feedback loop with no natural break.
No natural break. But wait, hasn't this happened before, like with the Industrial Revolution? Usually when technology displaces jobs, it creates new, higher value jobs.
That is the historical precedent, yes.
Right.
We went from farming to factories to offices.
Right.
But this theory argues that there is no third thing for humans to move to this time. We moved from manual labor to cognitive labor.
Yeah.
If cognitive labor is now fully automated, where do we go? What is the next frontier of human work if machines can think and plan better than we do?
That's a chilling thought. It really challenges the fundamental assumption of capitalism, doesn't it? The idea that efficiency always leads to growth.
It absolutely does. This suggests efficiency might lead to a hollowed-out economy. And it's not just theoretical anymore. We are seeing this play out in the stock market right now.
Look at IBM.
IBM is the poster child for this panic today. Their stock dropped over 13% in the single session.
Down 13%. For a company like IBM, that is a massive, massive move.
It's an earthquake. And it was triggered by a demonstration from Anthropic.
This was the Claude Code demo, right?
Correct. And to understand why this matters so much, you have to understand IBM's underlying business model. For decades, IBM has made an absolute fortune maintaining ancient banking code.
COBOL.
Yes, COBOL.
That's the programming language from the 1960s, isn't it?
Late 50s, actually. It is incredibly clunky, it's hard to read, and almost nobody learns it in school anymore.
But the banks still use it.
The entire global financial system essentially runs on it. So banks pay IBM massive consulting fees to keep it running and to slowly upgrade it. It's called COBOL modernization.
And it's a huge cash cow.
Huge. It's boring, difficult, highly specialized work, and it pays the bills for a lot of consultants.
And then Anthropic shows up.
Anthropic demonstrated that their AI could ingest that messy, archaic COBOL code and modernize it into clean, modern languages almost instantly.
Oh, wow. So that revenue stream, those billions of dollars in consulting fees for IBM.
They just evaporate, potentially overnight.
Why would a bank pay IBM's human consultants $300 an hour when an AI agent can do the entire migration for $30? The market looked at that and realized IBM's moat is totally gone.
Exactly. And it's not just IBM. Look at the entire software sector. Companies like Salesforce, CrowdStrike, all these companies that rely on charging headcount-based subscriptions.
The SaaSpocalypse.
Right. This is the core problem with seat-based pricing. If a software vendor charges you $100 per user per month, their revenue depends entirely on you having lots of human users.
Right. They need you to have a big team.
But if you use an internal AI to do the work of 10 people, you fire 9 of them. You don't need 10 software licenses anymore.
You just need one.
Or 0 if the AI is smart enough to just build its own internal tools. The efficiency of the customer literally destroys the revenue in the vendor.
So the market is just dumping the AI losers.
Aggressively dumping them. The Software and Services Index is down nearly 24% this year. Investors are terrified of holding companies whose business model is basically renting tools to humans.
It's amazing how quickly that narrative shifted. I mean, it went from buy absolutely everything with AI in the name to sell everything that AI might replace.
And that bifurcation in the market is key. The chip makers, the ones actually building the physical AI infrastructure, they are still holding up.
Because they're selling the picks and shovels.
Exactly. But the software layer, the application layer, is being decimated with a very specific kind of fear. It's not a fear that the tech won't work.
It's the fear that it will work too well.
Exactly. That it will work so well it destroys the pricing power of the entire industry.
Which perfectly transitions us to the second massive storyline hitting today. Because if the tech sector is melting down over too much efficiency, the broader economy is melting down over trade policy.
The Supreme Court ruling.
Right, we had this absolute bombshell drop on Friday.
Learning Resources, Inc. v. Trump. This is a historic ruling, a 6-3 decision. And to really grasp what happened, we have to talk about IEPA. Break that down for us. It stands for the International Emergency Economic Powers Act. It's a piece of legislation from the 1970s that gives the president broad powers to regulate commerce, but specifically during a declared national emergency.
Right.
The administration had been using IEPA to justify that universal baseline tariff we've all been living with since 2025. They basically declared that the U.S. trade deficit itself was a national emergency.
And the Supreme Court looked at that and said no.
They said that was a massive executive overreach. They ruled that IEPA does not authorize the president to impose broad global tariffs just because he doesn't like the trade balance.
Right.
They essentially told the executive branch, if you want to tax the whole world, you need to go through Congress.
So for a brief minute there over the weekend, it looked like the tariffs were actually gone.
For about a minute, yes. The ruling technically invalidated tariffs that were averaging an effective rate of about 7.7%, which, by the way, was the highest rate we've seen since 1947.
Wow. But the administration didn't just accept that. They pivoted immediately.
Instantly. They dug much deeper into trade law.
This is the Section 122 thing I'm seeing in all the headlines today.
Yes. They went into the Trade Act of 1974 and pulled out Section 122. This is a much more specific, rather obscure provision. It allows for tariffs specifically to deal with large and serious United States balance of payments deficits.
So they just found a different legal excuse for the exact same tax?
Actually, they found an excuse for a higher tax.
Mm-hmm.
The new executive order imposes a blanket 10% tariff on all countries. But then it was almost immediately raised to 15% as of February 21st.
Wait. So the Supreme Court says you can't do this, and the administration's response is, fine, I'll do it differently, and I'm going to make it twice as expensive.
That is effectively what just happened. The administration is betting that Section 122 is much harder to challenge in court because the statute specifically mentions balance of payments. But the economic impact on the ground is just immediate chaos. Businesses have no idea what is going on. They don't know which tariff legally applies right now, how long it will last, because Section 122 supposedly has a strict 150-day limit or what happens after that limit expires.
And this isn't just pocket change we're talking about. I was looking at the numbers on this. The estimate suggests this new tariff increases the tax burden per U.S. household by somewhere between $300 and $700 in 2026 alone.
It's a massive tax on the consumer.
Mm-hmm.
And that covers $1.2 trillion in annual imports.
1.2 trillion.
It's roughly 34% of everything we bring into the country. Everything from avocados at the grocery store to zinc for manufacturing is suddenly 15% more expensive the second it hits the port.
And obviously, the rest of the world isn't just taking this lying down.
Not at all. The geopolitical fallout is rapid and severe. The European Union has fully paused all trade talks.
Just walked away from the table.
Exactly. And China, India, and the UK are actively threatening countermeasures. There's even specific language from the administration threatening BRICS-aligned countries.
Wow.
We are seeing a real-time fracturing of the global trade order.
It's so incredibly ironic when you zoom out. We have the Department of Commerce hosting a fish fry for the Freedom 250 celebration, pushing these huge made in the USA themes.
Right.
While simultaneously we are entering a global trade war that might make it impossible to afford the frying oil for the fish fry.
It perfectly highlights the disconnect right now.
Right.
The celebratory political narrative on one side and the grinding economic reality on the other, which honestly is the perfect setup for tonight.
The State of the Union address.
The America at 250 address.
So we already have a pretty good idea what the president is going to say. We've seen the predicted talking points circulating. It's going to be all about this golden age.
The narrative will be overwhelmingly triumphant. You are going to hear, the State of the Union is the strongest it has ever been. Expect to hear a lot of victory laps about the one big beautiful bill, ending the Green New Deal era, achieving total energy dominance.
And this great healthcare plan I keep hearing about where they send money directly to patients.
Right, bypassing the traditional system. And expect a very aggressive foreign policy stance as well. Themes like peace through strength and heavily promoting the Golden Dome missile shield. It's going to be a massive victory lap.
But then you look at the polling data, and
Yeah.
it's really not that.
No. The latest polling is quite brutal, actually. 60% of Americans right now say the country is worse off than a year ago,
60%.
and 57% say the actual State of the Union is weak.
That is a massive, glaring gap.
Yeah.
The administration is seeing an economic miracle, but the people just see a struggle. Why is the disconnect so huge?
It comes down to the wealth effect versus the cost of living reality. We'll dive into this a bit more later, but high prices are absolutely crushing regular people. 46% of consumers cited high prices as a major strain on their personal finances in the most recent surveys. People feel poor at the grocery store.
But despite that, there are a few specific proposals expected in the speech tonight that really stood out to me. Things that might actually move the markets tomorrow.
Like the Trump accounts.
Yes, the
Yeah.
Trump accounts. Explain that one.
These are basically baby bonds, savings accounts for newborns funded by the government.
Okay.
It's a populistic measure designed to encourage wealth building from day one. It's clearly an attempt to address that massive inequality gap we just mentioned. The core idea is that every single child born in the U.S. gets a government-funded jumpstart to their net worth.
It's an interesting policy blend.
It really is. It's an interesting blend of conservative and almost socialist ideas, using direct government funds to create a nation of individual capitalists.
And then there's the AI dominance pledge.
This one is critical for the markets. The president is expected to frame AI tonight not as a scary economic solvent, like the tech sector is currently fearing.
Right, not this apocalypse.
Exactly. He's going to frame it as a strict national security imperative. We cannot let China lead in AI.
So framing it as an arms race.
An absolute arms race.
Okay.
And he's tying that directly to permitting reform for new data centers, basically sending the message, build the infrastructure here, build it fast, and we won't let environmental regulations or local zoning get in the way.
So while Wall Street is totally panicking that AI is going to destroy all these white-collar jobs, Washington is saying we need to build more of it as fast as possible to beat China.
Exactly. The geopolitical race is completely overriding the domestic economic concerns. The calculation in D.C. right now is, if we slow down AI development to save sauce jobs, China might speed up and gain military or strategic dominance. And that is an unacceptable risk to them.
And we can't forget crypto,
Right. The speech is expected to position the U.S. as the crypto capital of the world.
which is quite a pivot from a few years ago.
It's a very clear, bright green signal to the digital asset industry that the regulatory environment moving forward is going to be incredibly friendly. It's a deliberate attempt to capture that innovation and, of course, the tax revenue that comes with it.
Sure, we have this massive speech tonight, but frankly, if you talk to most traders, they are just waiting for tomorrow.
Tomorrow is the main event, without a doubt. NVIDIA earnings.
I have seen analysts calling it a stress test for the entire market. Is it really that important? I mean, at the end of the day, it's just one company.
It is the company. NVIDIA is currently the only thing holding up the entire AI narrative.
Okay.
Think about it. If the software stocks are crashing because people are terrified about AI destroying business value, NVIDIA is the ultimate counter-argument. They are the ones successfully selling the picks and shovels for the gold rush.
So they represent the physical build-out phase.
Exactly. They prove that real money is being spent.
So if they miss their earnings,
If they miss, or frankly, even if they just guide down slightly for the next quarter, the AI scare we talked about earlier goes from a simple sector rotation to a full-blown market crash.
wow.
It would confirm the deepest fear in the market right now, which is that the AI build-out is just a giant bubble. It would suggest that the companies building these massive AI data centers, Microsoft, Meta, Google, are finally tapping the brakes.
The expected numbers are just insane to look at. They're expected to report nearly $65.6 billion in revenue.
Which is up 66% year over year.
66% for a company that size. And EPS expected at $1.52.
And the wild thing is the prediction markets right now are 95% sure of a beat.
That actually scares me. When everyone is crowded on one side of the boat like that,
Exactly. The bar is set impossibly high. It's no longer enough for NVIDIA to just beat expectations. They have to crush the current quarter, and then they have to raise forward guidance perfectly. Any slight hesitation is going to be punished severely.
So what are the specific nuances we should be listening for on the earnings call tomorrow? I know everyone focuses on the top-line revenue, but what are the details that actually matter?
There are three main things you need to listen for. First is the product transition. NVIDIA is currently moving from their current Blackwell generation of chips to the next generation called Vera Rubin.
And usually when a new tech product comes out, like when a new iPhone is announced, people stop buying the old one while they wait for the new one.
Exactly. In the hardware industry, that's called the Osborne effect. We need to see if NVIDIA's customers are pausing their massive Blackwell orders to wait for Rubin.
Right.
If they are, revenue could hit a sudden air pocket. If NVIDIA gets on the call and says demand is temporarily pausing while customers wait for the next generation, the stock drops 10% instantly.
Okay, so watch the transition. What's the second thing?
China. Can they restart their massive sales to China? There's been a long pause due to geopolitical tensions and strict U.S. export controls.
Right.
If NVIDIA can announce a fully compliant chip that lets them sell back into that massive market, that's billions of dollars in upside. But given the trade war context we discussed earlier, with the tariffs and the retaliations, that seems like an incredibly delicate dance.
Yeah, the timing on that is tough. And the third thing.
The Meta deal. There are strong rumors circulating about a massive multi-year purchase agreement with Meta.
Zuckerberg buying more chips.
Right. If that deal is confirmed on the call, it sends a massive signal that the hyperscalers, the big tech giants, are still spending money like water.
Validating the whole CapEx boom.
Exactly. It tells the market Zuckerberg is still all in, the arms race is still on, so the party continues.
Okay, let's play this out. Say they absolute crush it, they beat on revenue, they raise guidance, the Meta deal is real. Does that fix the sauce-apocalypse panic we talked about?
It might calm it down temporarily. It reassures the market that the physical infrastructure build-out is real and continuing. But it doesn't solve the core problem of the AI negative feedback loop. It doesn't solve the fear that the technology itself might be inherently deflationary.
Right.
It just proves people are still buying the technology. It proves the acid is being sold in record volumes. It doesn't prove that the acid won't dissolve the floor once it's poured.
That is such a great analogy. So we've talked a lot about the high-level macro stuff today. Trade wars, AI replacing workers, the political narratives. But I really want to zoom in on the actual economy for a minute.
The data on the ground.
Yeah, because you mentioned earlier this split between the wealth effect and regular people.
The K-shaped economy. It is more pronounced right now than perhaps ever before.
The data coming out of the University of Michigan surveys is wild. Headline consumer confidence actually rose slightly to 87.6.
Right.
But when you peel back the layers of that number...
It's entirely driven by rich people.
Yeah.
Sentiment surged for people with large stock portfolios.
Because the market is near all-time highs.
Exactly. They log into their brokerage account, they look at their 401k, and they feel incredibly rich. They see their NVIDIA stock going up and they think, I can afford that new car. I can afford that European vacation.
But for everyone else in the survey...
It fell sharply. If you don't own a significant amount of stocks, you are just seeing high, sticky prices and increasing job insecurity. You see the headlines about IBM layoffs and the 15% tariff hikes, and you immediately pull back on spending. You walk into the grocery store, you look at the price of eggs and bread, and you feel like you are in a deep recession, even if the headline GDP number says the country is growing.
And we're seeing that exact same weakness show up in the manufacturing data too, aren't we?
Yes, clearly. Factory orders just fell 0.7%.
And the expectation was for a gain, wasn't it?
Yes, analysts expected an increase. This completely contradicts the manufacturing boom narrative that we're very likely going to hear in the State of the Union tonight.
The data just doesn't support the rhetoric.
Not at all. The industrial side of the economy is actually cooling down quite rapidly. We are seeing a complete decoupling of the financial economy, the stock market, and the real economy where we actually make things.
There's one more structural crack in the system I want to touch on before we wrap up. Private credit.
Yes.
This feels like one of those obscure financial things that absolutely nobody pays attention to until it suddenly explodes and takes down the economy.
This is the shadow bank risk.
Yeah.
And it is very real.
I saw a headline this morning about a major firm called Blue Owl. They're gating their investors.
Yes. Gating is just a polite Wall Street term for you cannot have your money back right now.
Which is never a good sign.
Never. Blue Owl is an absolute giant in the private credit space. These firms lend money to companies that can't or simply won't go to traditional banks for loans.
And who exactly do they lend to?
Software companies, tech companies.
Oh, I see the connection now.
Exactly. Private credit firms have lent tens of billions of dollars to the very same SaaS companies that are now sitting dead in the crosshairs of the AI scare.
The ones losing their seat-based pricing?
Yes. If AI destroys the core business model of a software company, if they lose all their human user seats because of those internal AI agents we talked about, that company's revenue collapses. And
Right.
if the revenue collapses, they can't pay back their massive loans to Blue Owl.
And if Blue Owl can't get paid by the software companies, their own investors can't get their money out.
And suddenly you have a major liquidity crisis on your hands. Senator Elizabeth Warren is already jumping all over this today, publicly calling them a shadowy private credit firm.
So it's getting political fast.
Very fast. This is exactly where the tech story becomes a banking story. It's the systemic fragility that the pessimistic scenarios are warning about. It's not just that a tech stock goes down, it's that the underlying loans supporting that entire software ecosystem might go bad all at once.
So, just to recap the sheer madness of today, we have a political narrative tonight of a golden age celebrating a massive national birthday.
Right.
We have a technological narrative playing out on Wall Street of creative destruction on steroids.
Yep.
And we have a grim financial reality on Main Street of 15% tariffs and sticky inflation squeezing the everyday consumer.
And sitting right in the middle of all this chaos is the Federal Reserve.
Oh man, the Fed.
Governor Waller gave a speech recently where he basically looked at all this and said, I don't know what to do.
He didn't use those exact words, though, did he?
No, not exactly,
Yeah.
but the sentiment was abundantly clear. He's looking at the data. Inflation is remaining sticky. The labor market is acting weird. The new tariffs are a massive inflationary wild card.
Right.
He's strongly signaling that maybe they don't cut interest rates yet. The economy is simply too chaotic and, frankly, too fragile to stimulate further right now.
It's just a lot to take in. It really feels like we are at a historic pivot point.
It absolutely is a pivot point. But if we pull back from the day-to-day noise, there is one provocative thought that I think summarizes this exact moment perfectly.
Let's hear it.
It goes all the way back to the AI economic solvent scenario we started with. Usually, in economics, efficiency is always viewed as a good thing.
Right. Doing more with less.
But right now, extreme efficiency is starting to look like the enemy of the economy itself. Think about it. If the ultimate goal of every corporation right now is to replace their human workforce with free software agents, who is left and actually buy their products?
Wow, we are literally automating the consumer out of the equation entirely.
Exactly. The market right now is heavily betting on NVIDIA, the builder of the human replacement, while simultaneously aggressively selling off the companies that employ those humans.
Yeah.
We are effectively cheering for the very thing that might make our current consumer-driven economic model completely obsolete. We are buying the robot that takes our job, just hoping that the robot stock goes up enough to pay for our groceries.
On that incredibly cheery note.
Hey, just telling you what the data says. If you're tuning in tonight, watch the State of the Union. But watch it with one eye on the AI section and the other eye firmly on your portfolio.
And maybe keep your fingers crossed for NVIDIA tomorrow afternoon. Thanks for listening to the Pro Ticker Deep Dive. We'll be back tomorrow to pick up the pieces.
Goodbye.